All right. All eyes on inventory. That's the title of a recent Jeff Snider blog post at Alhambra Investments. Jeff Snider is, of course, the head of global research for Alhambra Investments. It was posted on the 23rd of September. We're going to be talking about little e economics, the business cycle, the inventory cycle, the virtuous circle, as well as the vicious circle. Jeff, what are those things? And then we'll dig in step by step.
Well, the virtuous circle of economics, small e economics, is essentially the real good part, the recovery part of the business cycle, which is that, look, there's a little bit more risk taking after you get past the worst part, which is the trough. People start taking a little bit more risk. Consumers start spending a little more. That leads to, a little bit more spending activity, which leads to hiring activity, which leads to spending activity, which means that, good things beget other good things, and it continues in a virtuous circle, so that eventually that recession that you just went through is suddenly, nobody really remembers it after too long, because it was just a temporary, maybe sometimes painful, but temporary decline in activity. So the virtuous cycle of recovery is what we want to see. And there's an inventory component to it, or at least there used to be, which is that firms during recession used to get depleted of their inventory levels, and then they would start to build them back up. They would restock on inventory, and that would contribute to the risk-taking, the business activity, the producing of goods more than what's actually being demanded at that particular time. So restocking contributed positively to economic recovery periods. It was a big part of the virtuous circle.
And it would take place along the supply chain. It would start at the retailers, then move to the wholesalers, and then eventually the producers. And along the way, depending on the kind of cycle we were in, it could create a lot of good things, employment, investment, or unemployment and bankruptcy. So it was very important. You said,
that right. That's the other side of the business cycle, right? Going into the recession and contraction, and that's the kind of the opposite. So, retailers, wholesalers, even manufacturers, they all hold the various levels of inventory, and then retailers are obviously situated the closest to end user demand or economic demand and all that stuff. So, if retailers start to see a sag in their sales, they've got inventory coming in to try to meet a constant or consistent level of demand. And suddenly, if demand goes soft, inventory starts to pile up on the retailers. Now, retailers might look at that and say, well, this is just a little soft patch. We're not going to worry too much about it. Or they might say, I don't have the internal cash flow. I'm not really all that optimistic. Therefore, this inventory accumulation in our back warehouses, it's getting to be a little bit too much. I'm going to call up the wholesaler and say, hey, cut back on what you're sending me because I'm not selling it as fast as I used to. And the wholesaler might take the same approach and say, okay, this is just a soft patch. I'll keep doing everything I've been doing before. Or they might say, oh, this retailer is starting to say I don't want as much inventory. This other retailer is starting to tell me they don't want as much inventory. And this other one, same story. I got to call the producers and say, I don't need as much stuff from you. And the producers get that call, then they start to have to wonder, okay, now we have to adjust our production levels with what we're seeing in the inventory supply chain. And if the inventory throughout the supply chain is sort of backing up and stacking up and creating an order lag, then producers have to decide what they do. We have to cut back on production. And if it's a serious enough cutback in production, it kicks off the vicious cycle, which is where they say, well, orders are slowing down so much, we might have to cut overtime, for example, or we might have to cut back on shifts. And in the worst case scenario, if inventory really accumulates and the orders really start to fall down, we got to lay off workers. And the reason that kicks off the vicious cycle is because if they cut back on overtime and cut back on wages growth and things like that, and then lay off workers, that just means weaker consumption, which goes back to the retailer, and the retailer all of a sudden sees their demand fall off even more, and now there's more inventory, and it leads to an inventory cycle where there's too much inventory, leading to this vicious cycle of always cutting back on production, therefore workers, therefore consumption, too much inventory, cut back more, and it just goes on and on and on until you get what we used to call recession.
You just sketched out the supply chain, the inventory cycle, from the perspective of demand. We're thinking about the demand pull and its effect on the supply chain, because really, we've gotten used to that being the only factor affecting the inventory cycle because we've been living in an era of globalization, just-in-time inventory, and everything works like clockwork, and it's always going to be that way, and we don't have to worry about the other side. What happens if there's a supply disruption, which is what we've been living through the last couple of years, 18 months or so? Deglobalization, supply shocks, container shortages, port shutdowns. What happens from the supply perspective to the supply chain if retailers, producers, wholesalers are worried about even getting the necessary supplies to create the products?
Well, there's two things that can happen. I think people have been, the public by and large has been, their perception has been colored by the one, which is the automobile sector. In automobile sectors, you look at dealer inventories, they're as low as it's ever been, simply because dealers can't get enough cars on their lot and demand has been artificially boosted. And anyway, that's only part of what's going on in the inventory cycle. On the other side, which is basically the vast majority of everybody else, it's a little bit different story. As we've heard from companies like Walmart and Costco and others, what they've decided to do is just go crazy ordering stuff just to see if anything can make it through the supply bottlenecks, just to maintain some level of product on their shelves. So they've been, I'm exaggerating here. They've been double and triple ordering things just so that something can make its way through. And what that does is it kicks off a different kind of inventory cycle where the more they order to try to get stuff through, squeeze it through the supply chain that's all clogged up, the more that contributes to clogging the supply chain, which means then they have to order more to try to get stuff to arrive through that ridiculous mess, which just means that they just get worse and worse and worse. So the worse the supply chain logistics become, the more that retailers tend to order to get stuff through, then the worse the supply chain stuff gets, the more they order, and back and forth until we have absolutely no idea how much inventory is actually stuck at ports, on railroads in the United States, waiting to be loaded on a ship in China, for example. There is inventory all over the place, and I don't really believe that anybody has any good idea how much is out there, because dealers have just said, screw just in time, we're just going to deal with inventory. We're just going to get us whatever we can get our hands on today, and we'll worry about any excesses down the road.
Now we're going to talk about supply and demand from the perspective of this question that you ask. What happens when the logistics get more sorted out and then deliveries, rather than trickle through, come pouring out? This is the cyclical question for early 2022. Jeff, on a supply side, what will happen if it starts pouring through?
Well, I mean, right. I mean, that's where we start, right? Eventually, some of these bottlenecks will get worked out, and they'll get worked out sufficiently that goods start to flow more regularly. And that means, or potentially could mean, that you're just throwing orders, and you're just ordering inventory, hoping that some of it arrives. Well, what happens when it starts to arrive? And what happens when a lot of that stuff is flooded?
Yeah, no more orders.
Some of the big companies have said they're prepared. We've rented additional warehouses. We've built up our own capacities. We're prepared for that flood of inventory. And I think maybe that's true, given the one caveat, which we haven't talked about through all this weird inventory cycle, which is so long as demand maintains itself. So what they're saying is, yes, we've ordered all this inventory. We know at some point it's gonna arrive. We're gonna have to rent additional warehouses and space to store it all, but we don't expect to store it all that long, because haven't you seen, the economy's great. Everything's awesome in the United States. Retail sales are high. The goods economy is really doing very well. And we expect that to continue as, hey, Jay Powell's going to taper his QE. So obviously he believes things are moving in the right direction too. But what if it's not the case? What if demand is a touch softer or worse heading into 2022? And now retailers who thought they were prepared for this flood of inventory now sees that demand is quite a bit less, or maybe worse, than they thought it was when they started to build up this inventory through the supply chain.
That's right. That's the contention of this show since 2020, is that you just can't turn an economy on and off and hope that there isn't some sort of damage that takes, especially in the context of the last 14 years. So V-shaped recovery, I guess that's what they're counting on right now, this supply chain over ordering. But we're a little hesitant to believe that's going to happen, and we can turn to some data, PMI data, manufacturing services, and composite data for the ISM and from market in the United States. I'll pull up a couple of graphs. Jeff, you turn to them to kind of gauge where we may be in 2022.
Well, as expected, during the early part of the year, these PMIs went through the roof, which is what was supposed to have happened last year, and it finally happened this year. And the question is, why did it happen this year? On the manufacturing side, you can say, well, yeah, that's the goods economy recovering, and maybe that's just finally the U.S. economy getting out, throwing off of its COVID shackles and starting to behave normally again. But it may also be because simple recovery boosted by sort of the artificiality of Uncle Sam's depositing checks in Americans' accounts, and what are the actual impacts of that over time. In addition to all of that is this artificial inventory cycle where maybe manufacturing has maintained itself over this year because of this over ordering and persistent ordering that retailers and wholesalers are doing just to try to get any kind of delivery despite the supply bottlenecks. So manufacturing might be doing well for a number of reasons. It's not specifically, we can't specifically say what's the reason why manufacturing PMIs, for example, remain as elevated as they are, especially when you consider that some other parts of the industrial economy, as we see in industrial production numbers, are doing anywhere close to that well.
The services sector not doing so well. Perhaps it's because the economy itself, the underlying economy, is not healthy, or perhaps because of the Delta variant restrictions. And so the net effect is this composite index, which weighs together the manufacturing and the services, doesn't look as healthy. Is there anything that we should take away from this graph that you haven't already stated on the manufacturing side?
I think that, there's a couple things here. If you take the PMIs literally, and you can see there's a very good correlation with quarterly GDP growth. And so that says the recent PMI number, which was 54.5 for the month of September, the flash estimate for September, which really suggests somewhere around 2 or 3% in GDP growth, which is a huge disappointment from what we really need. And that really raises questions about what's going on here. Obviously, we've hit a soft spot. So the recovery this year was supposed to be pretty much consistent throughout the year, except now we're seeing uniform indications that the third quarter, somewhat the second quarter, but really the third quarter of this year has hit a rough patch. And the question is why? What is the soft patch? What is it really about? You raised the one possibility is that's nothing more than overreaction to the Delta variant and some reimposition of pandemic fighting measures across various parts of the U.S. as well as around the rest of the world. And maybe that accounts for why manufacturing PMIs remain high, but services PMIs have fallen more because service sector is impacted more by pandemic level restrictions. But it also may be that something more fundamental. Again, the manufacturing PMIs might be high because of this over-ordering in the supply chain that continues as supply bottlenecks continue to be a severe problem throughout that supply chain. But at the same time, it may be more fundamental problems in demand because maybe all of that government helicopter money earlier this year doesn't actually create much more than that short-run impact, a short-run level of artificiality that eventually wears off. So maybe it's Delta variant in the third quarter, but maybe it's just the other side of Uncle Sam's nickels, and we're starting to see less and less impact of that. And it makes sense it would happen in the service sector versus the manufacturing sector because manufacturing is robust for other reasons other than demand and user demand anyway, and that the services are being impacted because the economy post-helicopter maybe doesn't look as all that awesome and robust as it was supposed to. Because remember, capital economic theory says government spending and government activities is stimulus, which means it has a multiplier effect. So it's not just the amount that you pour into the economy in that particular time, but it's supposed to last more than just that immediate time period when you're actually doing it.
Jeff, that's it from me. Is there anything that we didn't cover that you wanted to tell the audience?
No, again, this is sort of our, underlying taper story. Jay Powell, again, taper doesn't really matter. The QE is all just smoke and mirrors. But Jay Powell is trying to project confidence in this growing economy and growing recovery story by saying, we're so confident in the unemployment rate version of the economy that we're going to cut back on our monetary policy. And so there are other examples we talked about in the previous episode, swap spreads and the liquidity monetary side, which are sort of, they're not consistent with that story. Now here we have this inventory potential inventory cycle that's overhanging, that is going to come, it's going to happen, it's going to come out to the other side of it at some point late this year, early next year. And is it going to be the robust demand story where retailers are really ready for the inventory overhang and have no trouble absorbing it? Or will it be the soft patch that we're seeing in the third quarter continues into the fourth quarter, maybe into next year, and then we have an old-fashioned 20th century inventory cycle contributing to the overall economic picture, which will be very different than the one that Jay Powell is imagining for his tapering.
I think I've got an idea what I'm going to ask David to draw for the art for the show. I think I'm going to have Jay Powell, maybe in an open convertible Cadillac, thinking he's going to get a ticker tape parade, normalization, recovery, except it's more of like a toilet paper roll hitting him in the head and bouncing off or something.
Or boxes of inventory just piling into his car.
I don't want to hurt him. Just a gentle toilet paper off the head. Jeff, I loved it, as I do every week. I hope you did as well, and I'll talk to you next week.
All right, take care, Emil.